So Avichal, a lot of our students know of you and have seen you do the conference circuit for TechCrunch and of course on a lot of the talk shows that are facing tech these days. But they may not know that you have deep California roots and almost all of your time was spent in the Bay Area. So can you talk a little bit about Prep Me, Spool, and then jumping off to some of the big guys like Google, Facebook, and now Web3?
Yeah, totally. So my background, by the way, good to see you, man. Thanks for having me. Yeah, my background is mostly as an entrepreneur. So I grew up in the Midwest and I came to Stanford for undergrad and grad school and then just stuck around, never left. And so went to Google for a few years, worked on search ranking and ads ranking on the product and engineering side. And I started a company right at the end of high school, like going into freshman year of college, which is where we first connected. And then we scaled that up and I sold it and then started another company called Spool, which we sold to Facebook. And I was a director of product at Facebook for a few years. And then left right at the end of 2016 to try to figure out what I wanted to do next, and had been dabbling with angel investing and was fortunate enough to be involved with a bunch of companies that have gone on to do well and are now a bunch of pre-IPO companies and hopefully products that you use, things like Notion and Figma and Airtable and a bunch of other good stuff. And I was doing a lot of crypto. And then in 2018, that we just sort of formalized everything we were doing on the crypto side into a firm called Electric Capital. So these days I run Electric with my co-founder Curtis, and we've scaled it up quite a bit. And we started small. We started with a $16 million fund back in 2018. And just announced we raised $1 billion in fresh capital that we're going to put to work now. We do mostly seed, Series A, but we do tokens, equity, we can do kind of anything. And maybe we'll talk about some of the specifics, but yeah, so, been in California now for, gosh, 15, almost 20 years at this point, since going to college. And yeah, probably won't leave anytime soon, but, we'll see.
But you're not the traditional VC. Like you haven't gone the route of like getting an MBA and kind of going the generalist route or the finance route. Like you're a coder, you have a deep competency in tech. And even at Electric, you stress that as being like one of the more important things that employees need to have to be able to do their job effectively.
Yeah.
Like what was the early thinking about having a technically minded VC company like across the board? Was that immediately evident to you, or were you just seeing that this could really be powerful?
Yeah, no, it was part of our core thesis. So the observation here is like, so, I mean, very, very much sort of informed by my early experiences at places like Google. Like Google notoriously had like an anti-MBA bias, and was very pro-engineer. And it was sort of, I think it was rooted in this idea that like engineers tend to be smart people and can figure things out. So just bet on smart people. And if you happen to have studied computer science or math, in like the early 2000s, or like, Larry and Sergey were getting off the ground like in the late 90s. If you studied computer science or math in the late 90s, you were probably pretty smart. It was a little bit more niche than it is today. It's kind of, why, I don't know, like all the hedge funds hire physics and math people. Like if you study that stuff, you're probably pretty smart and you can think abstractly. And if you can do that, you can probably do a lot of other things. And so that was kind of like the bias that a lot of the Googles of the world had, like 15, 20 years ago. For me, sort of the observation was having seen a bunch of those people be really, really successful. And after Mark Andreessen published his Software is Eating the World article or thesis, back in like 2010, I sort of internalized that. And, the realization there was sort of as software becomes embedded into every industry, then the critical thing as a business ends up being building good software, because that's how you acquire customers, through the internet. That's how you retain your customers. That's how you engage your customers. The businesses that are better at building good software tend to have better margins. They can offer new products and new services to their customers more quickly. And so your whole business has to like pivot and reorient to becoming a software business. And if that happens, the realization that I had, which I think implicitly a lot of other people have had as well, obviously, this is not like some brilliant insight that only I've had, but the realization there is in those kinds of businesses, the people who know how to build software end up being the most important people, because they actually know how to build the best software, and therefore like the things that actually make you money, the things that acquire your customers, the things that differentiate you against your competition, the people who know how to do those things are the most important people in an organization. They're the ones who then have all the decision-making authority, and you have to compensate them appropriately. And that's a really big pivot. You take a company like Procter and Gamble from, it's a 150-year-old company, and they're not a software business. It's a consumer products, CPG company. And in that business, like your brand managers, your brand marketing, like who has the, relationship with Walmart, that kind of stuff really matters. Who understands TV ads, like those are the things that really matter. And those are not the engineers, those are the brand managers. So that's why the brand managers are sort of like top of the hierarchy there, because they're the real revenue drivers in that business. But in software businesses, it's really engineers and product people and designers. And so that's why you implicitly have seen, for example, Satya is running Microsoft, Sundar is running Google. You sort of seeing, like Bezos was an engineer, Elon studied physics and, understands software, Mark studied computer science, and Strapa. You start just running through the biggest businesses in the world, and you're like, okay, it's not an accident that they're all run by people who understand software deeply. And so when we were thinking about starting Electric, we sort of said, well, if this happens to every industry, like when an industry starts to get eaten by software, what really happens is you have to redo your organization. You have to upend your organization and have it be run by software engineers and product people and designers. That hasn't happened to venture. And our belief was that with crypto, what was happening is like crypto is software eating money. Like now ones and zeros, are money, and it's a bearer instrument, you own it. And it's because ones and zeros are now money, it's programmable. And so you can like write code around that money. And so what that means is money movement also becomes digital. And so anything that involves capital markets, anything that involves the movement of money between people or businesses becomes digital and moves to this crypto stack. And venture capital is just one form of money movement. It's just one form of capital markets, capital deployment. And so that is also going to get eaten by ones and zeros and get eaten by software. And if that happens, then the same thing will happen to venture capital that has happened to retail and e-commerce and media, to social media. Essentially the software engineers have to take over, and the way that you build your organization has to be different. And so that was actually a pretty core thesis that we had with Electric back in 18 when we started it. And something we've been thinking about for many, many years, just as people who know how to build software. And so to us, it sort of felt inevitable. It was not obvious in terms of, it was not clearly correct. It was obvious to us that was like a potential thesis here and that it might work out that way. But I think until very recently, I don't think it was immediately obvious that was correct. And I think, between Electric and Paradigm and some of the newer firms that are sort of spinning up in crypto land, I don't think it was immediately obvious that was actually the way that like the next gen VC firms are going to be built. But I think it's increasingly becoming obvious to people that is kind of the DNA that you need to run the next gen VC firms.
Well, you were famously early, and people, as I understand it, would pepper you with questions that are already VCs, and they wanted to dip their toe in, and they recognize they just keep coming back to you again and again to get those core insights. And they're like, well, let me just push it off to you and have you this is too much to understand. There's too much to dig in there. Are you still seeing like traditional VCs being like, this is overwhelming, or are they feeling like it's just the newest iteration of tech? It's a part of the tech that I'm learning about, or how put off on Web3 are traditional VCs that you're talking with? Are they getting on board, or is it still a little bit of a friction point?
Depends a lot on the firm. Some people are really leaning in. Sequoia is really leaning in. They started a dedicated crypto fund. Obviously, Andreessen has really reoriented a lot of their business towards, a dedicated crypto fund. Greylock is leaning in. So there are definitely people that are putting a lot of resources into this, and they believe that this is the future, and it's really, really important to get up to speed, and they're spending resources on it. But a lot of other businesses that are not, they're sort of dabbling. They don't really understand it. They're sort of taking it part-time. And so they don't, I don't think they necessarily believe that it's the future, such that they need to reorient their whole business towards it. Which, I mean, I think it makes sense. It's like, if you're like a SaaS fintech, marketplace VC, it's been an amazing decade for you. And so sort of classic innovator's dilemma situation, which is like, okay, great. Like my core business is really, really good. There's this other thing over here that's like kind of different and weird, but it's a small market relative to my core business. Like, why would I pay attention to the thing that's, 1/10 the size of my core business. It's just like not where I should spend my time, given that I have a 10x bigger business over here. But that's how disruption happens, right? It's like the thing that is 10% of your business becomes 500% of your business. And if you didn't pay attention to it and the growth rates are really, really steep, then all of a sudden you get caught off guard. And then you look around and your organization isn't really well staffed to do those things. And now you're, on your back foot. And I suspect a lot of VC firms that will actually happen to them. I think they're not well equipped to do this. I think the exception here will either be, Sequoia is the best of the best for a reason, and they're being smart about it and getting ahead of it. And then I think the founder-led firms will do well here, like the people that or like Greylock has been through multiple generational transfers. I think they'll probably do well. But to me, it's not an accident that it's like Ribbit with Mickey is like leaning into this stuff. Andreessen with Mark and Ben still really, really involved. Like the people that are like founder-led, which is often what we see in a lot of businesses, right? Like founder-led firms tend to be able to pivot and embrace new challenges. And non-founder-led firms have, with professional CEOs, have a much harder time making those kinds of transitions, generational transfers. So I think venture will actually be pretty similar. Like I think the transition will be hard for most VC firms. I think they get caught off guard. They're not in a strong position 10 years from now, and a whole new crop of VCs has come in, at the Electrics and Paradigms of the world, and then a small number of the existing VCs, Sequoia, Andreessen, Ribbit, will pivot over. Founders Fund, like the folks that are essentially founder-led still in the VC firm, likely will like pivot over and do fund.
Our industry expert for our blockchain seminar series was Matt Kummel, who's one of the top guys at Barry Silbert, and he talks a lot about at the Digital Currency Group. They're thinking just that the transformative amount of ways that blockchain can be integrated and scale hasn't yet been scratched. Yeah. And I think that, there are people that are enthusiastic, there are people that are carefully so. Mm-hmm. And I think a lot of people throw Bitcoin maximalists or even digital ledger maximalists into a box where what they're thinking is without substance. And in a lot of the talks that you've done on numerous shows, you've discussed like the ways that these, the staking could go up 100x, or that the adoption or utility by shipping, or the different ways that this could be disruptive, is not just pie in the sky. Like it's being actively used, and there's real research that's behind it. When you're giving these suggestions of what could happen, or hypothesizing what's down the road, how is this received when you're in a room with someone and you're telling them this industry is going to 100x down the road? Are they like miffed? Like, how could you see this? Or do you give examples, or what's the best way for someone that's trying to understand this tech and its growth, to have it resonate with them? As the analogy of Web 1 and then move into Web 2? Or how do you have resonate the transformative ability of this technology to be adapted as a use case?
So I kind of think of it, I think they're like at a really, really high level, two ways to approach these markets. One is top down, one is bottoms up. From a top down perspective, I think you can look at capital allocators and just say, where are they spending their time? How do they deploy capital? What are the market segments? Yada, yada. And I think from that lens, you can look at something like crypto, Web3, and say, a lot of people are on board with the Bitcoin train. They're getting their heads around Ethereum. Like there's going to be a lot of capital and fund flows into this space. And that is just in its infancy. Like most pension funds and most sovereign wealth funds, and certainly no central banks have any Bitcoin or crypto exposure. And if you believe that there's a series of dominoes there that are going to fall, then that almost feels inevitable from a top-down perspective. That only really tells you that there's going to be money coming in. That doesn't really tell you that there's going to be value created. So you might look at Bitcoin as an asset class and say, okay, that's digital gold. I can see that working. I don't know what the case is for the other stuff, which is where I think the bottoms up approach is much more valuable. And the bottoms up approach essentially says, can you get your head around what the technology is capable of? And can you pay attention to where the people who create value are headed? And so I think for anybody who's trying to get their heads around it, I think one, just spending a lot of time with the tech and understanding it from first principles and saying, like, what are these distributed systems? Like, how do tokens work? Like, how does public-private key cryptography work? How does distributed consensus work? how does zero knowledge proofs work? Like there's real technology here, there's real computer science here, and understanding the implications of that, you know, with a fresh perspective. So, you know, I think if you say, hey, this is a worse version of the internet, that's kind of like looking at the iPhone and saying like, this is a worse version of a computer. It's like, okay, well, yeah, there's no keyboard and the screen is smaller and the internet connection is slower, but that's not the point. The point is there's GPS built in and it's an ever-present connection and there's a camera on the device, and the fact that it's a touchscreen means you can do different things. Like you have to look at it through the things it can do, not the things that it does worse than the prior generation of stuff. And understanding the technology is a good place to do that through that lens. And then the second is generally when you see these kinds of platform shifts happen, you see that people who understand the technology and the builders kind of go in first. And so this is why at Electric we do our developer report every year, because you know, if you just look at where the engineer is going, that's a pretty good proxy for where value will get created. And so, you know, like my heuristic for my entire career has basically just been go wherever the smartest people are. So it's like, why did I go to Google? It's just like, well, I did an interview loop and there were no bozos on the interview loop. Like usually when you interview at a company, you're like, okay, most of the people there were pretty good, but there were like these two people on the loop. And I'm like, why, how did they work there? They don't seem that good. And at Google, everybody was amazing in like 2004. You're just like, holy shit, these people are so good. Same thing at Facebook. When we were thinking about where to sell our company, we talked to a bunch of companies, we had multiple offers. But if you talked to, you know, Mark and Cheryl and Chris Cox and, you know, Mike Bernal and Boz and Shrep in, you know, 2011, you just went and talked to these people. It was very obvious they were going to take over the world. It was just so clear. And I think the same thing is happening with crypto and Web3. You just go, you know, there are a bunch of mediocre people in the space, people who can't get a job at a top tech company and make a bunch of money, but also all of the smartest people are here. And so kind of from like a distribution, probability distribution perspective, or like a, you know, an ability distribution perspective, like the mean may be lower, or the median may be lower, but like on the far end of that tail, on like the tail end of that distribution, you know, the right tail where all the most brilliant people are, there's way more of those people in crypto than there are in any other sector right now. And so that's what I look at. Is like, is there real technology here? Is the technology uniquely good at some new set of things that, you know, the old platforms are not good at? And that's the right lens to look at the technology. And are there enough builders coming in to do something interesting with the technology? And if both those things are true, then it's really a timing question. It's like, okay, there's going to be value created here, and maybe you're just 10 years too early. But sort of like the value creation will happen. That's how I look at it. You know, like I think the top-down stuff is capital flows. The bottoms-up stuff is like, will value actually be created? And to me, both those things are true. And then the real open question is really one of market timing. You know, there are like a lot of ideas on the internet in the mid to late 90s that were just 10 years too early. Social networks and, you know, like grocery showing up at your doorstep, and like those things are just 10 years too early. And so that's the real risk. That's the thing that you just can't really predict.
I love your interviews because there's at least for me, like an aha moment every 10 minutes. And the one that most deeply resonated from one of your talks was how humans overestimate the success of something they perceive to be low risk, like a SaaS, and overestimate something that's more opaque, you know, like a non-sovereign store of value, supersonic jets, like things that you might not think would do better. And the reports you put out are so great because in much the same way that Buffett will put out these reports that really resonate with people, your reports not only resonate, but they have these insights that are powerful in their takeaways. So can you talk a little bit about how people have misperceptions of risk profiles and why that's important to understand?
Yeah. So like one of the things I think about, like one of the things I think you have to think about as an investor, generally speaking, are like, where do your emotional, like humans are not, you know, when an economist writes a paper, they sort of assume humans are rational. And then that's why there's been this whole sort of behavioral finance, you know, field that's emerged, behavioral economics, because, you know, 20 years ago, 30 years ago, people realized humans are not 100% rational agents. And so we end up doing a lot of things that sort of on the surface don't seem to make any sense. And one of the learnings from me out of that, just sort of thinking about it, was, well, if that's true, and mass, humans have a bunch of cognitive biases because we're biological entities and we sort of, you know, through natural selection there's certain reasons our brains work certain ways. what are the like large scale implications of that? And I think one of the implications of that is at scale, that means that if everybody has the same biases because our brains are wired similarly, then we're going to have the same blind spots. And so there are a set of interesting blind spots that humans have. One of which you're alluding to, which is, we're bad at low probability events. And it's because when something that's low probability happens that is catastrophic, it can really like, if you don't have resources, that can really screw you up. So like, as primates that know how to build tools, but like could really get set back years if like, fire burns everything down, we sort of have this intuitive sense of like, prevent loss. So we don't operate in this environment where like things are frictionless. Like you could lose many years of work if like your house burns down, right? So we intuitively have this like loss aversion. What that means is that we like don't really understand low probability events intuitively. Another sort of cognitive bias that we have is we don't really understand exponential growth, which is why we have this like COVID situation that we do. Is like people intuitively can't get their heads around what exponential growth really means. And it's because we're large macrobiological entities. We're not bacteria. And so like as a primate in the jungle or on the savannah, you didn't just like go to sleep and then wake up and all of a sudden there's a giant tree next to you, or like a tree didn't grow up underneath you and now you're like on top of the tree. Like that's not how biology works at a macro scale, right? So we don't really intuitively understand exponential growth. We also don't understand large numbers, right? Because as primates, we're used to dealing in like 5 and 10. So if I show you this, you're like, oh, that's 5. If I show you this, you're like, oh, that's 10. And you might be able to do that up to like 30 really fast. But if I show you a jar full of jelly beans, you can't tell me if it's 263 jelly beans or 424 jelly beans or 1,000. You just can't tell. Like our brains are not wired to deal with large numbers that way. So you look at those 3 things and you say, oh, okay, humans have this like loss aversion bias. We have this like bad understanding of low probability events because we have fear of those things. And so we have to overestimate certain things and we underestimate certain things. We don't understand exponential growth. We don't understand large numbers. And you look at all those things and you're like, oh, that's actually exactly what a startup is. Like a startup is a low probability outcome event that has exponential growth baked in and deals with really large numbers, like, billions of people doing a thing. And so our intuitions around how startups work are totally wrong, which is why so much of what it means to be a good startup founder or what it means to be a good startup investor is really counterintuitive. And the only way you can learn it is through an apprenticeship. Like the only way to become you can't like read a book and become a good founder. You just have to like go be a good founder and learn from the world's best investors, which is why you have such perpetuation of the best firms stay the best firms, right? Which is like why Sequoia managed to stay on top, because there's all this like counterintuitive stuff. And if you can impart that knowledge into founders and the people that work at your firm, you actually have a competitive advantage because there's no book that's written on this stuff. It's just all tribal knowledge and it moves very quickly. And so putting all that together, like one of the beliefs that I have is that we are really bad at predicting things like, a new digital money, non-sovereign store of value that emerges, or predicting that like we can actually build reusable rockets and get to space, or predicting that we can build supersonic airplanes like Boom. And we way overestimate the likelihood that a SaaS startup will succeed. Right? It's sort of back to this idea of these like probability distributions we actually have like really bad mental models for. And so one of the things I've come to believe is that things that seem, sorry, that's my camera. So things that seem likely to happen are probably less likely to happen than you think they are. And things that seem not that likely to happen are actually probably more likely to think than you might happen. So I think like our intuitions around a lot of these things are just wrong. And so you have to be like really thoughtful and diligent about how likely something actually is. And so what that means is like, I think people don't really understand that you can actually take on bigger challenges and be more successful than you think, which is, I think, a really good lesson for investors and founders. Like, and I think there's a feedback loop there, which is like, the more ambitious your idea, in some sense, the easier it becomes to succeed because you also cut through the noise. Like, there's just not that many people trying to build a supersonic airplane. Now, that doesn't mean anybody can get up and do it necessarily, but if you actually have the right skills and you have the right willpower to make it happen, you're actually more likely to be successful with that than you are like a typical SaaS startup, because with a typical SaaS startup, like raising money is harder and like hiring people is harder because who wants to work at yet another SaaS startup? And how do you cut through the noise? And like your customers are being bombarded by SaaS startups all the time trying to sell stuff to them. And so actually it turns out like being more ambitious and pursuing harder things, your likelihood of success actually goes up, which is a little bit counterintuitive in my opinion. So yeah, that's sort of a long answer to your question of like, what is that belief structure and why?
No, I love podcasts, first of all, but then I love podcasts that get you in the mind of people that are dissecting important issues. Like on the All In podcast, Chamath Palihapitiya talked about his investment into Virgin Galactic and how like the revenue streams are ones that you might not even think of, and how people that get it, it resonates so deeply. And then, people in the comment section, people are like completely mind blown about how this is like a blue water opportunity or blue ocean, and it's all the tailwinds are there. And it's funny how when something is explained well too, it'll resonate with them in the right way. And that's the beauty of the podcast, where you can break these concepts down for people, or that they can start thinking about how their thinking is completely misaligned with reality in all of these cases.
Yeah.
So
that's very much what it means, I think, to be a good founder or to be a good investor, right? It's like, this is like the number one thing we look for when we're talking to founders is like, is there something in the world that most people believe to be true that turns out to not be true? And why is that the case? And so if a founder has like found this thing that they like, if I go into a meeting and I believe X and I walk out of the meeting and I believe not X, then that's pretty profound. And that's not to say I'm like super smart, I'm like the smartest person on the planet or anything like that. Not at all. It's actually like it's actually the opposite, right? It's like I'm trying to like, I'm kind of stupid and I'm trying to find people who are way smarter than me. And when you find one of these people where they're like, no, everybody believes X, but everybody's wrong, actually not X is true, and let me walk you through the rationale and why from first principles, that's like brilliant. And those insights, when they happen, you're like, wow, that's totally right. But like the best founders do that. The best investors do that. It's like you actually, what you're trying to do is be contrarian and right. And from first principles, being able to walk through why something is true. And, given all, like, I like people like Peter Thiel or Balaji, or Mark Andreessen, they're just brilliant at this, right? You're starting from like all the same information to somebody, and then you piece it together in such a way that you're like, actually, the conclusion that everybody else has come to is the wrong conclusion. And let me walk you through from first principles why. That's like a superpower if you can do it. That's what we strive to do. Actually, it's hard. It's very, very hard.
Well, here's another widely held belief, is that the vertical organizations that we use in society, with a C-level that are operating and calling all the shots, operates better than like a co-op or, these organizations that are distributed. So like when you think of a DAO, someone told me the other day that like, you're never going to beat the efficiency of an organization with like three strong leaders, like a CEO, CFO, and COO that are just making it all happen. And with the DAO, they're like, there's too many chefs in the kitchen. But then I gave them the analogy of, you look at a venture firm with a bunch of partners or a law firm, or is there a friction point between like a horizontally organized company and something that's vertically, or what's kind of the middle ground there you think that works?
Well, so I don't think it's so much a middle ground. I think it's like, it's kind of like the platform analogy we were talking about before. It's just like certain types of organizations are good at certain kinds of things. And you need to build an organization that's good at pursuing the mission of the organization. And generally speaking, dictatorships or CEO type structures are efficient, but not very resilient. And so you can get more done quickly. There's a single decision maker, stuff moves. And so, like look at China, like they can just shut down a city and they're like, cool, we're just going to shut everybody down. You now have to stay home. And it's been remarkably effective. I mean, they've pulled, more people out of poverty in the last 20 years than ever in the history of humanity. And so you can do like really, really amazing things efficiently. The problem is that those organizations tend not to be very resilient. And more distributed power structures like democracy tend to be inefficient, but much more resilient. So the question is, what are you really optimizing for? What are you really trying to drive? What are you trying to get at? So I don't think DAOs are necessarily going to outcompete corporations in certain endeavors. Like, is it likely that a DAO outcompetes Elon Musk when it comes to like building a rocket? Probably not. Could a DAO outcompete let's say, foundations and endowments on capital deployment, yeah, that doesn't seem crazy to me. Like, is it a more efficient version of some sort of distributed power structure on like how to allocate capital and not lose the money because you're really optimizing for resilience? That seems very plausible to me, right? So I think the question really is like, where do these organizations have superpowers, and where are they stronger than legacy organizations, and why?
I'll hit you with a few more theoretical, and then we'll weave it back to just some practical for some of our students. So
Sure.
Your framework metrics that companies are should look at if they want to be able to best serve themselves.
Yeah.
You have how many people use your thing, how deeply do they use it, how good is your product at doing what you claim that it can do, and how much money will it make?
Yeah.
Why did you pick those, or which ones do you think that really, I would assume all of them, but like if there's one or two that really have the main thrust that companies need to keep their eye on the ball on, what would you say they were?
Depends on the stage that you're at. I mean, I
Mhm.
think in the early stages, it's all about retention. Like, the only thing that matters is you've built something that people actually want. And the only signal that you have is, are people coming back to use it over and over and over again, even if it's a small number of people. Once you get that right, and intuitively you're really sort of focused on like, is the product really, really good at what it claims to do? Because that's how you ultimately drive retention. Those two are the really, really important ones on the front end. And then once you have that, then you can focus on how to get more people and drive growth. And once you have that, you can focus on how you actually make money. And that's not to say you can just like, build it and they will come. That doesn't mean you can just like build it and one day hope to monetize. Like, you want to think through those things because that will impact what you build from the early days, but that just means that's not necessarily where you focus. But I think, yeah, fundamentally it's like, have you built a thing that people really, really love and want to use? And so is there some sense that this product is really, really, really good at what it does? And the best signal of that often is that like people are coming back to use it over and over again.
Do you think blockchain's most important utility is it being trustless and facilitating international trust and providing that way that people can operate across borders and not have to really worry about some bad actors doing something that will pull the rug from under them? Or like, what do you see as the core benefit of a trustless digital ledger?
Yeah, I think the main thing is essentially it's allowing a bunch of mutually distrusting parties to agree on the state of the world. And so you don't have to trust counterparties, you don't have to trust other people. It's, there's a mechanism by which you can arrive at a shared understanding of what the world really is. And then the practical applications of that often are going to be in sort of settlement as a starting point, because like money settlement is a problem where like, I want to have a system where I don't have to trust the other person. It's great if I do. It's like, that's nice. But there are lots and lots of cases where I don't want to have to trust the other person, or I can't trust the other person. And that's where you get scale, because as soon as I can do transactions or trades or be a counterparty to a transaction where I don't have to trust the other person, that's what allows you to scale. And that's where the stuff gets really powerful. And then ultimately you can extend that to a lot of other things, where if you have this idea of trustlessness, which I think is a killer feature, you can start to extend that to things beyond money. You can start to extend that to, like, where do I store my data? How do I execute this code? How do I deliver this web page? Like, a bunch of other stuff naturally comes out of that. But yeah, I think the fundamental primitive here at the base layer is the ability to operate trustlessly, the ability to operate without trusting my counterparty, without trusting the government, without trusting some intermediary, just like the system imposes that. The trade-off, of course, is you get inefficiency. And in order to truly have that, you have to trade off some efficiency, because trust allows for efficiency. And in some cases, that's the right trade-off. In some cases, like, actually less efficient but trustless is actually the right trade-off, because that is a very different thing than what the existing systems are designed for. Most existing systems are designed for trust us, or trust your counterparty, or the government has trust. And as a result of that trust, we can get efficiency. And here you're just optimizing for a very different thing.
Oh, yeah. Can you talk a little bit about tokenomics best practices? I was talking to someone the other day, and they were very keen on a project, and they were thinking that it had an interesting use case, had some IP that was tied to it, and that it was a good value. But I'm like, well, I mean, it looks fine, but it has 900% token inflation a year.
Yeah.
What are your thoughts on just tokenomics and that getting well structured as the basis for a blockchain project?
Yeah, I mean, the token economics are really important. It's a big, it's one of the four considerations we have. We look at the technology, we look at the team, we look at the go-to-market, we look at the token economics. So it's very, very important to get right. I think the best practices on this are still being determined. Like, I don't think it's so easy as saying like, here's the, you can't check the boxes and like, okay, it works now, because this stuff just moves so quickly. And so, you look at something like vote escrow lockups, and VE lockups weren't a thing 18 months ago. And it's increasingly looking like that might be an important part of the token economics, because then you can empower the people who are the most long-term minded and give them more governance power. And so these things move very, very quickly. So there isn't, I mean, this goes back to kind of what we were talking about before, which is like, the only way to be a really good founder is to go build some stuff and just like build it and play with it. And a lot of the tribal knowledge around how to be a good investor, be a good founder, you just have to like get from doing. So there's literally no book that's written about what the best practices are around token economics or vote escrow lockups. In part because we don't even know what the consequences are, right? Like, by the time we figure out what the consequences are 2 to 4 years from now with vote escrow stuff, the world will have moved on to some other stuff, right? And so all this stuff is very tribal knowledge around best practices, and it moves very, very quickly. So yeah, there isn't really a great set of best practices right now. In part because, for example, take something even like Bitcoin. You're like, okay, well, it's a fixed supply thing, yada yada. You get like token. You can get, as a miner, you can get fees. I think it's still a little bit TBD. I mean, I think that definitely creates some specific mechanics, but it's not clear that that's necessarily the right token economic scheme for, like, I don't know, international remittance kind of product, or that's necessarily the right token economic scheme for a DeFi product, or that's necessarily the right token economic scheme for some sort of decentralized infrastructure, right? So I don't know, we're sort of like, we're on the frontier here and we're inventing it. A proxy here might be in the 90s, when people were evaluating internet businesses, the way that they evaluated the businesses was how many eyeballs are looking at the website. And you're like, oh, that was pretty naive, because like a payments business and an e-commerce business and a media business and a CRM to like manage your customers like Salesforce, those are such dramatically different businesses. They cannot all be valued on eyeballs, right? Like, we had to come up with like the frameworks. Oh, a CRM business has this like recurring revenue thing, and their customers are different. And like a payments business actually has this sort of GMV thing, and they have to like pay their customers out so they get some float and there's some revenue come in. Like, we had to come up with all these frameworks, and it took us like 10 or 15 years. And that's kind of, I think, where we are with token economics. It's just like, I suspect the token economics are going to be very different for the very different use cases. There's not going to be like one solution that fits all of them. And I think probably for a lot of this stuff, we haven't even invented the right business models and the right terminology to be able to have these discussions yet. And that's kind of what the next 10 years are going to be about, is like figuring out a lot of these best practices.
One of the most popular questions that you've gotten in the last month or two has been around, Musk and Twitter and decentralized social media. There's such a lack of understanding here that people are so excited to ask you questions about it, because they know you know a thing or two about it. And DeSo, which was previously on BitCloud, has a huge footprint here in LA. Yeah. So just wanted to know, like, what kind of thoughts do you have on just decentralized social as a whole? Does it just go back to like who's ultimately doing the determining in terms of the suitability of someone's post to be presented to the community, or your thoughts are that it's a huge leap forward from Web 2? I mean, having time at Facebook, that some of the smartest people are in Web 2, and a lot of them are in Web 3 too. So kind of where do you stand on that?
I think there's two things there. One is like specifically on social stuff in Web 3, and then one is sort of like the migration of talent from Web 2 to Web 3. So on the first, I don't think we've really seen the right approach for decentralized social yet. A lot of it is too skeuomorphic, and that's not a criticism of anybody in particular. It's just, if you look at the history of how these things work, generally speaking, it, like the first wave of stuff is very skeuomorphic. So if you look at, let's say, newspapers as they were moving online in the 90s, they didn't realize that the thing was actually social media, where like anybody can create content and distribute it. literally what the New York Times did was they took the New York Times front page, which has these like columns and a big header and like a headline and like a big New York Times across the top, and they just took that and put it on a web page. And so for like the first 5 or 7 years of NewYorkTimes.com, it just literally looked like the thing that you would pick up like physically, at like on the corner, or like got delivered to your house every day. And so it's very skeuomorphic, right? Or like the early iPhone apps were that way too. Like literally there's a book and it's sitting on a bookshelf. And so if you want to read a book, there's like a virtual wooden bookshelf and you like tap on it and the book opens up. And you're like, that just is like not the right way to do reading on a phone. And so that's kind of the era I think we are in right now with social stuff, is like we're sort of copy pasting a bunch of stuff from Web 2 social, and Web 3 social likely looks very different. And specifically what I mean by that is, like, to me, the interesting thing is that in Web 2, the graph was the critical asset, and it was closed. Like you can't get your friend graph out of Facebook at scale. You can as an individual, you can download it, but like a business can't come in and just like, get the graph. And in Web3, that's inverted, right? Like the graph is on chain, and so you can see the graph. And so the graph is open, and that changes a lot of stuff downstream. So, I don't think we've quite hit the second wave of social yet. And I think that's going to be the way that actually works in Web3, is like it's going to look very Web3 native and like it'll look very different from Web2. To the second point around like Web2 people coming into Web3, I think that's phenomenal. Like we're seeing so much talent come in. Engineers and machine learning people and product people and designers. Like it's just the last 6 months in particular have been just kind of wild in terms of the caliber of people coming into the space. And so I suspect as all of these people get up to speed on all things Web3, like 18 months from now, we'll start to see a lot of DeFi social stuff that really starts to hit, as everybody has gone through like 12 to 18 months of skeuomorphic learning and being like, oh, that was wrong for these reasons. We shipped it to users and we learned a bunch. And that's where I think a lot of the stuff will get really, really interesting. So I'm very optimistic, and I think we'll kind of like I think like you'll see a lot of people heads down building for the next 2 years, and then we'll learn a bunch of stuff 2 to 3 years from now, and then like 4 years from now, a lot of people will say, "Oh, that was not the right way to do it, and now we know how to do it the right way." And so you're kind of, I think, see like an echo boom. It's part of why I think we also get these cycles in crypto, because it's about how long it takes for people to like try an idea, experiment with it, it fails, and then they realize like the right thing to do is X, right? So with Bitcoin, it was like, oh, we should be able to like have colored coins and programmable coins. So you got the sort of first wave of like Namecoin and Mastercoin and sort of these things that we're trying to like improve. And then we realized like you can't fork Bitcoin. It's like the wrong architecture. Like what you really wanted something like Ethereum. So like that took a couple of years, right? That took until like 2017 to like really get right. And then all of a sudden it hit, right? Same thing with NFTs. Like the first wave of it, 2017, was not quite the right thing, and it took like 4 years, and then now it's starting to work, right? So I kind of feel like decentralized social might be that. We might be kind of in like 2017 era of it, where it's going to be like the next wave of it that really hits.
Yeah, I mean, and here in LA, the NFT thing has been so big because you have case law for art that's pretty well stamped out, and you have A-list celebrities like Mila Kunis that are like, I feel comfortable, and her people ironed out a way that it's digital art. There's fairly entrenched into the case law that we're just throwing out digital art. It doesn't have a revenue stream. It's, you can watch the cartoons if you have the NFT in your wallet, and all sorts of the ones that are around that. And people in LA are looking for a lot of ways to use media in the Web3 space, but also use it in a way that won't get them in hot water from a regulatory standpoint. And I think you'll agree that it's definitely getting ironed out in California with the governor's proclamation, and then with a lot of what Biden was saying. And you saw that Chicago is getting a lot more built out by FTX, and a lot of exchanges are going there, and people are coming over from the Bahamas, coming over from Singapore and Hong Kong. So it's getting better. But how's the ecosystem for Web3 in California? It's getting formed because it's all so new, right? At this point, everyone's just figuring things out and trying to do something with the venture money that they're given in a way that is compliant stateside, right?
Yeah, I think actually California is being pretty good about this, all things considered. And I think that like the governor's executive order last week was like a good step in the right direction. And I think a lot of people in California are pro-innovation, and they know that that's like the lifeblood of the economy here. So they're just being smart and rational about like, how do we keep these people in the state? It's really been at the federal level that it's been challenging on regulatory, specifically, I think, around SEC and sort of lack of clarity around around sort of rules and sort of trying to sort of lead with enforcement and prosecution rather than through rulemaking. And I think that's it's a missed opportunity. And we're seeing this. We actually just tweeted out today some data around how the US has been losing market share to other countries in terms of developers. And you're seeing developers move to Southeast Asia, Eastern Europe, India. And it's because in those markets, there's such a big need for a lot of these tools because the financial systems don't work, because there's an opportunity to make money internationally with NFTs now. Like the way the money flows work and how sort of like the labor arbitrage kind of works here, those markets really understand the power and the potential here. And there are a lot of people that are willing to take risks. And the US is sort of, at the federal level has not been particularly hospitable. That's not to say they're necessarily killing it. But I think there's just a lot of ambiguity, and that creates, that's not a fertile ground for entrepreneurs to want to start businesses and for people to want to invest in that stuff. So I think it's unfortunately a big missed opportunity, and it's really at the federal level that I think we need to start thinking about some of these things. Like I think even if California does all the right things, it's entirely possible that the federal environment is such that it sort of kills things.
From your time being a part-time partner at Y Combinator, I'm sure you had a lot of experience with giving advice for young people and people that are in our class. There's it's pretty even split between people that are mid career and are trying to, because we're associated with the Anderson School, do something to lead a department as their company pivots or bank pivots into the digitization movement. So wonder what advice you'd give to someone that's starting their career and then someone that's well into their career that wants to use their knowledge of blockchain in a leadership capacity?
Actually, I think my advice for both is probably the same, which is if you just like get in and build something and do it, and don't overthink it too much. And what I mean by that is like I think like the way most people think about career decisions is basically, what job do I want? What company should I work at? Who am I going to be working with? And then maybe they think about the market that they're in. So like, oh, I want to be a machine learning engineer. Like, what are the companies that are really good at this? Oh, it's these like 6 companies. Then who do I get to work with? It's like these other good machine learning people. And then you're probably not even thinking about the fact that like Netflix is in a particular market, even though they do a bunch of ML stuff, and like, some other business, I don't know, Coinbase is in a totally different market, right? And really what you should be doing is inverting all of that. Like literally the right way to think about it is the exact opposite of that. Like the only thing that matters is which market you're in. Like 2005, if you just pick social, then the next decade of your life was awesome. Or, in 1995, if you pick the internet, like the next decade of your life was, despite 2001, it was still pretty great. The next most important thing actually is who you work with. So just find the smartest possible people in a market to work with. So in like, 2001, if you're like, okay, I think social might be a thing, let me just go hang out with Reid Hoffman. You probably did really well over the next 10 years. You were involved in the right things. You got to like be on the cutting edge. You got to be involved in really great high impact projects. The next most important thing is actually the company that you work for. So like if you went to Facebook in 2008, that's the only thing that mattered. It like literally did not matter if you were like on the customer support team. The only thing that mattered was that you were at Facebook. And if you're smart and hardworking and talented, you could work your way over to being product or design or whatever. And then the least most important thing is actually what job you do. And so people just like think about these things totally backwards, in my opinion. And so like step one is, can you convince yourself that crypto, Web3, like, or some subsegment of that, NFTs or decentralized infrastructure or whatever, is actually the right market to be in? Then I would go just find the smartest possible people you can find. And then I would think about what company you want to be at. And then I would think about what job you actually do. And I don't think that matters if it's like early career or late career, because I think back to the idea of like cognitive biases that people have, whether you're early career or late career kind of doesn't matter. It's sort of a little bit of sunk cost fallacy. Like what you should do is look at what your skills are and look at what the market is that you want to be in and evaluate rationally going forward. And like even if you're mid-career, you have a certain set of skills, which is great. But that certain set of skills only is like the fourth consideration, right? Like the first consideration is what market are you in? And second is like, where are the absolute smartest people that you can go hang out with? And then it's like, what company do you work for? And then the last consideration is like, what job do you actually have?
Those are great. And to finish, I thought that we would wrap up the way you started with Edtech. So I'd be interested to hear what your thoughts are on education online, the distance learning, the way that people are distributing these classes on Coursera, edX. Kind of, what are your thoughts on this new wave of education that's accelerated by the pandemic?
Yeah, it's good for the world to have all this stuff out there and have this tooling out there and have these products out there. They're terrible businesses in the Western world, at least. And so, it sort of depends on which perspective you're looking at. I think from a societal perspective, it'll be great. I think like decentralized knowledge and decentralizing access to information are really, really good things for the world. And in the East, China, India, Korea, people are willing to pay for this stuff, like culturally, and people are willing to pay out of pocket a lot of money for it. So you can build pretty big businesses there. In the West, there's sort of a cultural challenge, which is that the West has had it too good since World War II. And so we've gotten soft, and most people don't value education, and they think of education as somebody else's problem. And so by and large, and what I mean by that is like we've essentially outsourced to teachers, and we said, okay, well, like it's the teacher's fault if this doesn't work, or it's the school district's fault if this doesn't work. And so the buying psychology in the US and Western Europe doesn't lend itself to big businesses being built here. And so you can just look at like the strength of these businesses, like in an Eastern and Western company, and you can just look at their margins and you can look at the structure of the businesses. And I think the root of it is actually a cultural thing. So I think things like, anything that decentralizes knowledge and access to information and tooling and allows people to like emerge from anywhere in the world, really, really, really good for the world and really good for society. And then, if you're thinking of it as a founder, like if anybody in the audience that's listening to this is thinking about starting an edtech company, just think of it as a nonprofit. Like you won't ever make any money doing it. And if it's like truly your life's work and you want to like make the world a better place, cool, go for it. Just understand that it's not a venture backable business. And if you try to run it that way, you'll probably run it into the ground and waste, many years of your life.
What are ways that our students can keep up with your reading? Is your Twitter your best distribution point? Okay. Yeah,
just @Avichal on Twitter. It's the best place to find me.
Well, I really appreciate you coming on the show today. And
good to see you, man.
We've had a lot of history, and I appreciate the insights that you've given me over the years. So I'll encourage the class to check out Avichal on Twitter. And then they do have the annual reports, which I'll include in the coursework, and we'll do a follow-up discussion based on some of the questions that we talk about and addressed here. So awesome. Avichal, appreciate you coming by.
Good to see you. Thanks for the time.